Thank you, Sharmaji. Thank you, Sangviji. And I would thank all the learned audience to have come back again to hear me. And as Mr. Sharmaji, in fact, very candidly put, I'm known to be spending a good amount of time, whether I would actually deal with the relevant topic or not. It is just in the lighter vein. And he has already scared you enough saying that I could take a full day working you. But be rest assured and extend beyond 1.5 hours for the day session. And on the last occasion, we discussed about 6 decisions, and there were a few decisions which remained yet to be discussed. So we would continue from where we left. So today we will start off with a very interesting decision of Supreme Court in Maruti Suzuki Limited, and it's reported in 421 ITR 510. And here is a very interesting case where the assessee is following the net basis of accounting. You know, when you would buy the goods, the tax credits would be captured in a separate asset account, and he would only account for the net of purchases. And then he would utilize the amount lying in the credit as against the subsequent payments which he would make of those taxes. And this is the assessment year 99-2000, where at the end of the year, he had unutilized modward credit as well as the sales tax recoverable, a similar kind of credit which was available as per the then applicable sales tax law to which the assessee was subject to. And these amounts, which ran into huge amounts, 60 plus crores in the case of modward credit, and 3 plus crore in the case of sales tax recoverable account. What the assessee did is, assessee considered that as soon as it purchased the goods, it paid even these amounts, and it treated it as though it is paid, irrespective of whether it was due to be paid or not, and it made the claim under section 43B, saying that irrespective of the method of accounting I would follow, as long as these duties stood paid. When I bought the goods itself, I had paid these duties, irrespective of it is available as a credit as at the end of the year, irrespective of the fact that I have not eventually set it off, I would still be getting the benefit of section 43B on the basis of cash system of accounting, which is forced upon me by section 43B. The officer, in fact, disallowed. He did not allow. Assessee lost his cases throughout. When the matter went to the Supreme Court looked at section 43B clause A. The words there used are any sum payable by the assessee by way of tax, duty, cess, or fee. Now, the question before the Supreme Court was as to whether this modward credit or the sales tax recoverable amount, which was paid to the vendor by the assessee during the impugned previous year, could it be regarded as any sum payable by the assessee by way of tax? What the Supreme Court said is, 43B would allow the deduction only when a sum is payable by way of tax. In your case, what Supreme Court felt is, sum is not payable by way of tax. What was payable by you was payable as a buyer to the vendor. When the vendor sold the goods to you, it was his obligation. When he cleared the goods in his factory, it was his obligation to pay it as tax. What you have paid is not as tax. What you have paid is as a consideration to the vendor. Therefore, the Supreme Court said that you would not get this benefit of modward credit under section 43B because you have not paid it by way of tax, and therefore you are not eligible to claim this credit. Now, what the assessee did is, assessee then claimed, okay, if you don't allow it to me under 43B, I have utilized all these amounts lying as credit in the very next month. In the month of April itself, I've utilized it. Because I've utilized it, it is to be deemed to have been paid in April. And in terms of the first proviso to section 43B, even if it is paid after the end of the previous year, because it is paid before the due date for filing the return of income, if not under the bare provision of 43B, at least in terms of the first proviso, I shall get the benefit. But the Supreme Court said you will get the benefit of first proviso only if some amount was found payable in the relevant previous year and you paid it in the subsequent year. In your case, you have cleared the goods not in the year, but in the subsequent year. So it did not become payable in the current year, which is to be treated as subsequently paid. Therefore, Supreme Court said that you would not even get the benefit of the first proviso. So this is what the Supreme Court said, and accordingly, Supreme Court denied the claim of assessee in respect of the modwat credit, which was lying unutilized at the end of the year. Assessee, in fact, lost the case here. Now, let's see whether the decision of the Honorable Supreme Court is, like acceptable in the kind of law and the provisions we have. If you very technically look at what the Supreme Court has said, in fact, it is right. Because the very starting language of Section 43B is this: notwithstanding anything contained in any other provision of the Act, a deduction otherwise allowable. So most importantly, although the Supreme Court did not rely on this particular preamble words of Section 43B, in fact, what it held is in line with the preamble words of Section 43B. Deduction is otherwise allowable. It's only when the deduction is otherwise allowable, 43B will deny the benefit of the deduction if you have not paid. And alternatively, if you have not paid by end of year, but if you pay it after the end of the year, but before the due date for filing the return of income, it would be allowed. But if it is otherwise allowable, now the question is, when the assessee did not clear the relevant goods and hence had not become liable to pay the excise duty, it was not otherwise liable to pay the excise duty during the relevant year. Because it was not otherwise liable to pay the excise duty during the relevant year, Section 43B would not apply. So what Supreme Court said is technically right. We cannot have any great quarrel with this particular proposition. But difficulty is not that. The difficulty is the inconsistent stand. In fact, if you were to look at the decision of Supreme Court in Modipon's case, 400 ITR 1, unfortunately, this particular decision doesn't appear to have been cited when Maruti Udyog was argued. Now, if you look at Modipon's case in paragraph 9 dealt with PLA deposit. As you're aware, those days you had two types of remittances. One is production ledger account deposit, one is RG23, a part 2 credit in respect of the modwat credit. Now, Modipon dealt with PLA credit. What Modipon said is, as soon as the assessee deposits X amount in the PLA account, although he had not manufactured the goods, he had not paid the goods, and no excise duty has yet become payable, on the basis of the principle and the ratio which other courts have held in the past, 43B would only say that as soon as you pay, it will have to be allowed as a deduction. And Supreme Court said that in PLA, withdrawal is not ordinarily permissible. Withdrawal would be permissible only in a very special case. This is very similar to even your modwat credit. You would not be allowed to take away cash from the amount of credit lying in your modwat account. And therefore, Supreme Court said you cannot wait till production to happen and the goods to be cleared. As soon as the amount is deposited in the PLA account, having regard to the object of Section 43, you will have to get the benefit of deduction. Now, the point for consideration is what is allowable in the context of PLA. There is no rhyme and reason as to why it should not be allowed in the case of modwat credit. So both essentially are payments. One is a direct payment to the government exchequer. The other one is an indirect payment through the vendor to the government exchequer. In the concept of value-added scheme of taxation, both will have to be treated as the prior taxes paid. If PLA deposit, withdrawal of which would be extremely difficult, could be allowed as a deduction on the premise of mere deposit in the PLA, irrespective of the fact that the goods are not yet cleared the factory, as well as the liability to pay excise duty had not even arisen. If PLA deposit were to be allowed as a deduction, then there is no rhyme and reason as to why the modwat credit should not be allowed as a deduction. No, but unfortunately, both are the decisions of the Honorable Supreme Court. Modipon is in the context of PLA, and Maruti Udyog is in the context of the Senvat credit or the modwat credit. Now, my only point is possibly if Modipon had been brought to the knowledge and the notice of the Supreme Court as it discussed Maruti Suzuki, it would have been a more reasoned decision where the Supreme Court either would have distinguished on some basis which could be discernible to us, the decision of Modipa, or would have possibly changed its view on Maruti Suzuki's case. Now, what is the takeaway we have here? Look at the present scheme of GST, where you have the electronic cash credit and the electronic cash ledger and the electronic credit ledger. All your input tax claims will come in your electronic credit ledger, and all your cash deposits will go in electronic cash ledger. You could equate electronic cash ledger deposit to PLA and electronic credit ledger to the moderate credit of the excess regime. Now, applying Maruti Suzuki and Modipan's case together, whatever deposits you make in the electronic cash ledger, you will get the benefit of 43B, although you are not liable to pay the GST. Whereas, what comes to electronic credit ledger, you will not get the benefit because you have not yet become liable to pay the GST in respect of the goods or the supply which you have made. In fact, there's an interesting decision of Chennai High Court in the context of GST, where when some interest is levied for belated payment, the department levied interest not only in respect of belated adjustment of electronic cash ledger, also in respect of belated adjustment of electronic credit ledger. Assessee argued before the Madras High Court and convinced the Madras High Court to say that a mere delay in adjustment of amount lying in electronic credit ledger would not require levy of interest because the amount already stood paid to the government. So meaning the court in this decision has treated both what is lying in cash register as well as in credit register as one and the same. However, in the light of decision of this Supreme Court here, in these two cases, we will have dichotomy of treatment. When it comes to electronic cash ledger, you'll be allowed irrespective of when it has become actually liable to be paid. In respect of electronic credit ledger, you would not get the benefit of deduction till you actually utilize it. Now, there is another interesting follow-out aspect, of course, which is not new, which may have to be kept in mind about the gross method and the net method. And you will have the accounting standards, which would have allowed you to do both the methods, whereas the ICDS and 145A would ask you only to follow the gross method. And you have the decision of Indo-Nippon's case in 261 ITR 275, where the Supreme Court said whichever method you would follow is revenue neutral. You have the ICAI guidance note also suggesting that these methods are essentially revenue neutral. And this also is a point which may have to be kept in mind as you would look at the developments that have taken place thanks to the decision of the Supreme Court in Modipan's case and Maruti Udyog's case. Now with this, Mr. Sharma, do we have any queries on this which we'll take before we go to next decision?
Yes. Philip Bhai, can you start?
Yeah, you start, Mr. Sanjay.
Yeah. The first one is if Chaitanya sir, if tax is paid under protest against the demand which is agitated, what would be the situation?
Payment of tax is, as soon as you pay the tax in respect of the demand is already raised, merely because you have raised an appeal would not in any way stop your accrual. Kedarnath Jude's case, 82 ITR 363 is very clear on this. So that position has not changed. Here is a case where the demand has not arisen. You had only deposited in advance in one case by direct payment, in another case through the payment to the vendor in respect of purchase of goods, credit is lying to your account.
Okay. Dilip bhai, will take the second one or should I continue?
Yeah, you can continue.
Yeah.
We will continue, sir. We'll go to the next case.
One more important this thing is, what would be the situation vis-a-vis now changes in 145A and 145 and ICDS coming into the picture? Any effect would be there?
See, this is a problem which did exist as soon as 145A came in, which insisted that your purchase, sales and your inventory will have to be valued on gross basis. But people are taking recourse to the decision of Supreme Court in Indo-Nippon's case 261 ITR 275 and saying that it's essentially revenue neutral. See, when the input-output ratio is absolutely identical, it could possibly be revenue neutral. Otherwise, it need not be essentially revenue neutral, at least in a particular period of time. But the point for consideration is different here. the ratio which we are discussing here is a little different. It's got nothing to do with your method of accounting. It's got something to do with as to what you are eligible to claim under 43B.
Yes.
Sir, is it that in case of this that earlier judgment 400 and ITR, it was a case of manufacturer, and as you said, in this case, Maruti's case, the amount was paid as a purchase price. So is that distinction is not there, sir?
No. What Indo-Nippon only held was whether you follow net method or the gross method, it is revenue neutral. That's all it held.
Okay. Okay.
It's a very short decision of about a page. It just upheld the decision of High Court, saying that it is revenue neutral. It would not make any difference.
Okay. Yeah, we can move to next.
Yeah. Next question. Yeah, I've gone through the questions. Yeah, sir has almost covered all the queries which are there. Yeah, we can go to the next question, sir. Yeah.
Now we will go to another case of Maruti Suzuki. Very interesting case. Here is a case of, it's reported in 416 ITR 613. And here is a case where the assessment involved is 1213. And there was a scheme of amalgamation with appointed date being 1/4/2012. On the last session, we discussed Dalmia case and amalgamation. Here we discuss Maruti Suzuki in the scheme of amalgamation on a different context altogether. Now, here is a case where on 1st of April 2012 is the appointed date, but the court order came a little later, that is on 29th January 2013. And as soon as the court order came, on 2nd of April 2013, Maruti intimates the assessing officer about the amalgamation. Now, case is selected for scrutiny, and unfortunately, assessing officer, though he is intimated of the amalgamation, he would issue a notice under 143.2 followed by 142.1 notice on 26 September 2013. Kindly note the date here. This date is subsequent not only to the appointed date, but also to the date of sanction of amalgamation, and also to the date on which the assessee intimated the assessing officer about the amalgamation. And on 11th of March 2016, a draft assessment order was passed in the name of SPIL, that is predecessor company. Now, the post-passing of the draft order, Maruti Suzuki participated in the assessment proceedings, although it had intimated that the amalgamation has taken place. Though the draft order is passed in the name of the predecessor, it in fact filed the appeal before the DRP, calling itself a successor in interest to erstwhile SPIL. It called itself in the cost title as Maruti Suzuki, followed within brackets the words as successor in interest of the erstwhile SPIL. On 14th of October 2016, look at this, DRP issues directions not in the name of predecessor. It issues the direction in the name of Maruti Suzuki. It issues the direction in the name of Maruti Suzuki, and within brackets it says a successor in interest of erstwhile SPIL since amalgamated. But what the assessing officer does is, he makes a mistake. On 31st of October of 2016, he passes an order. The order is named after SPIL predecessor, immediately followed by bracketed words, amalgamated with MSIL. So technically he has written both the names, but it started off with the name of predecessor, then within brackets amalgamated with MSIL. So ITAT quashed the assessment order having been passed on a non-existing entity. High Court would dismiss the departmental appeal on the basis of High Court's earlier decisions, the Delhi High Court, in the case of spice entertainment or spice infotainment. You know, there's a little bit of confusion in the name as to whether it is entertainment or infotainment. And department filed an appeal before the Supreme Court. Now, what did Revenue argue before the Supreme Court? Very interestingly, Revenue argued that look at the final order of the assessment. Assessing officer had mentioned both the names. It mentioned SPIL and within brackets amalgamated with MSIL. So as long as both names exist, it is only a technical error. It could be cured under 292B. Subsequent, further, the Revenue argued that anyway, Here is a case where the amalgamating company was duly represented by amalgamated company. There was no cause of any concern because opportunity of being heard, ad alteram partem has been completely adhered to. No prejudice is caused to the parties because of this assessment order, more particularly when both names are written. It's after all a very venial breach and therefore it has to be tolerated. In fact, the revenue also relied on Skylight Hospitality case. Skylight Hospitality case where Delhi High Court distinguished the earlier decision and held that mere issue of notice in the name of non-existing company could at the most be a curable defect under 292B in the peculiar fact before Skylight Hospitality. So on this basis, the revenue argued. And what did the Supreme Court find? Look at the findings of the Supreme Court. Supreme Court said that once SPIL, predecessor company, upon amalgamation ceased to exist, it is no more a person at all. It is no more a person in terms of section 2 within brackets 31. A notice under 143(2) was issued on 26th of September on SPIL, and this notice is, in fact, this notice is issued even after the department was intimated about the amalgamation aspect. And therefore, the Supreme Court said that this notice itself couldn't have been issued in the case of a non-existing entity. Now, accordingly, the Supreme Court said very initiation is void ab initio. You couldn't have issued the notice in the case of a non-existing entity. And as regards the argument of the revenue that both names are mentioned, Supreme Court did not deal with this argument, but it only went on to say that the assessment order is bad being passed on a non-existent entity. Now, in fact, none of these decisions went about saying why an assessment order ought not to be passed on a dead person. One aspect, of course, is a dead person or a non-existing entity couldn't even be regarded as a person in terms of 2 within brackets 31. That's an important point which has to be taken into consideration. Other point is, when you pass an order on X, whether he is a person or not, how could you have passed an order without even hearing him? You hear somebody else who could be a successor. That would not amount to hearing the predecessor. And therefore, it's impermissible to pass an order on a non-existing person is another point which will have to be taken note of. 2 aspects do arise here. The first important aspect is the doctrine of merger. Now, here is a case where Supreme Court relied on the decision of the Supreme Court in an earlier case of Kunaya Muhammad versus State of Kerala, 245 ITR 360. Here is a case where the Supreme Court brought out as to the concept of merger, concept of ratio decedent in terms of Article 141 of the Constitution. When SLP is dismissed, civil appeal is dismissed. You would know that as against the order of High Court, when you go to the Supreme Court, you file an SLP. So Supreme Court has an option of dismissing SLP then and there, or allowing the SLP to be allowed, and whereby SLP will become a civil appeal. Now, if SLP is dismissed without a speaking order, the threshold itself, the Supreme Court decides not to entertain the appeal. And therefore, the order of High Court does not merge with the order of Supreme Court. So doctrine of merger would not apply when the SLP is dismissed. That means it is dismissal at the threshold. Instead, if Supreme Court allows SLP and thereby SLP converts itself into a civil appeal, and if the civil appeal is dismissed without a speaking order, because it has already become an appeal, irrespective of the fact that the civil appeal is dismissed without a speaking order, the doctrine of merger would apply, as a result whereof whatever High Court has said will now become what is said by Supreme Court, because it merges with the order, though it is not a speaking order. So non-speaking dismissal of SLP is not the same as non-speaking dismissal of civil appeal. So this was already stated by Supreme Court. This is reiterated here. Why this issue came before Maruti Suzuki was, in the case of Spice Infotainment, the Delhi High Court had given an elaborate decision saying that the issue of notice and passing of assessment order on a non-existing entity is bad in law. It went to the Supreme Court. SLP was converted into civil appeal. And upon conversion of civil appeal, Supreme Court merely said that we will not intend to interfere with this, and civil appeal dismissed. So it's a non-speaking order, but because it is dismissal of a civil appeal, it has the stamp of approval of the Supreme Court. So this is an important point of distinction of dismissal of SLP without a speaking order, dismissal of civil appeal without a speaking order. This point will have to be noted, and it is reiterated in Maruti Suzuki's case. One small qualification here: if the SLP is dismissed without the speaking order, as we already stated, it is rejection at the threshold. Nothing would happen here. It wouldn't amount to approving the decision of High Court. It is just that the Supreme Court is saying we do not entertain this at the very threshold itself. Sometimes what may happen is they may dismiss the SLP with a speaking order. Like in the case of Skylight Hospitality, it is a case of dismissal of SLP. It is not a case of dismissal of civil appeal, but it is a case of dismissal of SLP with a speaking order. Now, what the Supreme Court said is, although doctrine of merger would not apply where the SLP is dismissed with a speaking order, whatever Supreme Court says through its words in the scheme of dismissal of SLP with the speaking order will still have the force of law in terms of Article 141 of the Constitution. That ratio will bind, but doctrine of merger would not apply, is what the fine distinction between dismissal of SLP without a speaking order and dismissal of SLP with a speaking order. Now coming to our case here, there were two decisions which relied upon. One of Spice Infotainment, one of Skylight Hospitality. In the case of Spice Infotainment, it is a case of an amalgamation, whereas in the case of Skylight Hospitality, it is a case of conversion of a company into LLP. In the case of Skylight, all the prior records, there was a tax evasion petition, there were reasons to believe, there was an approval of Principal Commission of Income Tax, all made a reference to LLP. Only mistake is inadvertently notice was issued in the name of erstwhile company. Because all earlier correspondences referred to LLP, intention was to deal with LLP in the reassessment proceeding. The Supreme High Court held that in the peculiar facts of this case, it could be at most called as a mistake curable under 292B. And on this basis, Supreme Court dismissed the SLP. Whereas in the case of Spice Infotainment, is a case of an amalgamation. On facts, it is closer to the facts of Maruti case, and it was a case of dismissal of civil appeal. As I said earlier, dismissal of civil appeal is having higher sanctity as compared to dismissal of SLP. Now, another interesting aspect here is the Supreme Court said participation is not an estoppel because it goes to the root of the matter. It's the jurisdictional issue that assessment order couldn't have been passed on a non-existing entity. It's important that like mere participation would not stop the assessee taking this jurisdictional ground. However, one interesting aspect here is Supreme Court in Maruti Suzuki said that assessee intimated the department, and despite the intimation, department went ahead and issued the notice. Now take a case where there is an amalgamation. Assessee does not inform the department. Can the department distinguish the case of Maruti Suzuki? Saying Maruti Suzuki dealt with a factual matrix which consisted of intimation to the department post-amalgamation. Here is a case where the assessee did not intimate, and hence Maruti Suzuki would not apply. We had an interesting writ petition in the Karnataka High Court in E-Mudra's case, decided as late as on 10th of December of 2019, yet to be reported. In this case, very interestingly, assessee did not inform. However, assessee took an argument. In fact, I argued this case. We took an argument in the High Court saying that in the amalgamation petition before the High Court, assessee was heard, department was heard, and notices were issued under the Companies Act, under the company's rules. So department was in the know of things. And when the amalgamation order was passed, a copy was marked to them also. Therefore, it was argued before the Karnataka High Court that department was aware. And on this basis, the Karnataka High Court quashed the assessment order passed on a non-existing entity. Although the assessee did not specifically inform the department that the amalgamation has taken place, but on the basis that in the scheme of amalgamation, department was heard and therefore department cannot take a plea that it was not aware of amalgamation. Now, slightly extending this logic to the case of a death of person. Many cases we see that a person would have been deceased. Department would have issued notice in the name of the deceased. And it would have issued the notice in the name of the deceased quite at the end. Now, assessee would argue that how could they have issued notice on the deceased? In this scheme of things, you would notice that at least a dozen of Gujarat High Court decisions and a few Maharashtra, Bombay High Court decisions and a few Delhi High Court decisions, most of the decisions and Chennai High Court in Alamelu Virappan's case, most High Court decisions have held that the notice on the dead person, assessment order on the dead person is void ab initio. But Maruti Suzuki, which dealt with amalgamation, dealt with a case where subsequent intimation was made. Now, in the case of death of a person, can you make use of the decision of Supreme Court in Maruti Suzuki? On the contrary, can the department say, we will not apply Maruti Suzuki, you will not get the benefit of Maruti Suzuki because you have not intimated after the death of the person, the legal representative has not intimated. Now, if you look at it a little more in detail, unlike in the case of an amalgamation where there is a chance for department to be intimated in terms of Companies Act and the company rules, in the case of a death of a person, the persons who are taking care of a person who is on the deathbed will not inform and give a notice to the department that here is an assessee who is going to die and come and have your objections, if any. So it's quite like ridiculous to have this kind of a proposition in the case of death of the person. Secondly, in the case of death of the person, you cannot expect the legal representatives who are grieving the death of the person to be intelligent enough, to be practical enough to intimate the department. And if there is any such requirement, Section 159, which will deal with the case of a legal representative, would have had this kind of a clause. If you look at 159, unlike Section 176, which deals with closure of business, 178, which deals with appointment of an official liquidator, where you are, if you look at 176, for example, if the business ceases to exist within 15 days, you'll have to intimate. Under 178, if an official liquidator is appointed, if a liquidator is appointed within 30 days, you'll have to intimate. But Section 159, which deals with the assessment of the legal representative, would not have any such requirement. So this was exactly what was held by Madras High Court in Alamelu Virappan's case, where Madras High Court asked the revenue, you show me some act, some provision in the act, some provision in the rule, which will require the legal representatives of the deceased to intimate the department. With the department, most unfortunately, and of course it couldn't have, established through any provision of law or the rule to bring about this requirement. And interestingly, in Maruti Suzuki's case, Alamelu Virappan's case was also referred. Although it dealt with the death of the person and the facts before Maruti Suzuki were relating to amalgamation of a company, this decision was referred to. So we have to, understand that there is an implied approval of the decision of Alamelu Virappan's case by the decision in Maruti case. And therefore, in the case of death of a person, the benefit of arguing that the assessment order passed in the name of a dead person is bad would be available to the legal representatives, despite the fact that no intimation as such has gone to the department on the death of the person. One point needs to be noted here. If the department is prudent enough, it should issue the notice within the limitation time. And then the legal representatives will have to inform, at least after the notice is issued, that it is issued in the name of the deceased. Then the department will have sufficient time under 149 to be issuing a notice in the name of the legal representative. However, in many cases, it would so happen that as on the last day, or just about a few days before the time limit would expire under 149, before the expiry of 6 years, 3-4 days, last day, department would issue the notice in the name of the deceased. In the case of Karnataka High Court in E-Mudra, same thing happened. The notice was issued on the last day of the period of limitation. So it was argued before the High Court that even if we were to intimate the department, practically it would take at least a few days for us to intimate the department. What would the department have done? How could the department have issued the notice in the name of the legal representative when the limitation period had expired? You have the decision of Supreme Court in Hope Textiles case in 205 ITR. Limitation is sacrosanct. Once the limitation passes, it's not a question of any prejudice. See, for example, if 31st March is the due date, on 1st of April, if the notice is issued, there may not be a great issue of prejudice to the assessee. But the fact remains is the assessing officer has become functus officio. He ceases to have jurisdiction. So one of the important points of limitation is that post the limitation expiry, the concerned officer becomes functus officio. He'll be dehoused the jurisdiction to be passing any order. So this is the point that needs to be noted in terms of the limitation. Now, one another important takeaway of the decision of Supreme Court is consistency principle. For consistency, we always use extensively Radhaswamy Sexton's case in 193 ITR 321. Supreme Court makes it a little more vocal here. Supreme Court says that if there is a decision of Supreme Court in the past, or if certain a set of facts is accepted, it is extremely necessary that the individual, to understand and appreciate that the individual affairs are conducted, business is carried out in the expectation of consistency and uniformity and certainty. And it is neither expedient nor desirable to break this principle. It is extremely essential to attach a lot of significance to the principle of consistency. So we'll have one more decision now to use a decision of the Honorable Supreme Court to argue on consistency principle. Now, if you have closely watched the facts of Maruti, in this case, notice under 143(2) was issued after the court order, after the appointed date, after the court order, after the intimation. If you go to spice and infotainment, here notice was properly issued, but after the appointed date and before the order of court. See, until and unless the order of court is available, you would not really know whether the amalgamation will be taken through or not. Court may permit, court may not permit amalgamation. So before the order of the court sanctioning the scheme of amalgamation, but after the appointed date, 143(2) notice was issued. But what the Delhi High Court in this case interestingly said is that notice which was issued after the appointed date, but before the date of sanction, but in the name of non-existing entity, you have to substitute the notice. You can't go ahead and pass the order in the name of the successor merely on the strength of notice which was validly issued in the case of the predecessor, but before the date of order, but after the appointed date. And going back to Saraswati Syndicate and going back to Marshall and Sons case, once the appointed date is there and once the final order of court is passed, with effect from the appointed date, the company ceases to exist. So what is important is to substitute the notice. And how do you substitute the notice of 143(2)? You could do it only if the time limit is available. If the time limit is not available, you will have to do reassessment and issue a notice under 148 in the name of the successor, not in the name of the predecessor. So therefore, department has to be smart enough here. They cannot be taking up the proceedings at the fag end. And in case there is a case of an issue of notice of 143(2), in the case of predecessor, to substitute if the time has lapsed under 143(2), it is important for the department to drop the proceedings, scrutiny proceedings, and go ahead and issue 148 notice in the name of the successor. But unfortunately, department doesn't appear to have taken note of all the developments. We continue to see the cases where the mistakes continues to happen and where the orders and the notices continue to be passed in the name of the predecessor. Yes, sir. Any questions?
Sir, as you said, though there is no provision under section 159, but once legal representative having informed, that is a proper notice, sir. Is it? Hello? Hello?
So what 159 says is, please look at 159. What it says is a proceeding that was already initiated could be continued. A proceeding that could have been initiated could now be initiated. But what is important is, what could have been initiated could be initiated in the name of the successor. It is impermissible to issue notice in the name of the predecessor.
Right.
In both the cases, after the appointed date, please understand, after the appointed date, no matter when the court order came ultimately sanctioning the approval, the predecessor company ceased to exist. In both the cases of Spice as well as Maruti, notices at 143(2) were issued after the appointed date. So it couldn't be treated as a proceeding initiated on the predecessor. It is a case of a proceeding initiated. It is not a, because predecessor does not exist anymore. What 159 permits is?
Yeah, what I'm saying is, sir, after the legal representative intimates and notices are issued in the name of legal heir, then it is proper, no, sir?
Then it is proper. Then it's absolutely proper.
Achha, one
it's
more
absolutely
thing,
proper.
One more thing,
yes,
whether a notice is to be issued on all legal representatives or one of the representatives is okay.
So this is already no more res integra. Jayaprakash Singh's case, the Honorable Supreme Court has already held that it is not necessary that the notices will have to be issued to all the legal representatives. In fact, if you look at Maruti Suzuki, it has distinguished Jayaprakash Singh's case.
Yes.
Sir, I'll just like to extend what Sharmaji discussed. Now, in 159(2)(b), what it says that once the new notice was issued, when the assessee was alive, and thereafter that the assessee expires, and after expiry, it has been intimated to the assessing officer that the assessee has expired. But the assessing officer, when now the notices are generated on the system, they do not have any procedure of issuing a e-notice and going ahead, sir. So in that situation, what the assessing officer intimates to the legal representative that though the notice is issued in the name of the deceased, but he mentions that you kindly make necessary requirements for a legal representative and comply with the details called for. In that situation,
So it's like this. There is a small difference between the case of an amalgamation and the case of death of a person. In your case, under 159, if it is found that a notice under 143(2) was validly issued in the name of the person who had not yet deceased, please understand, it is not the case of issue of notice after his death. Any issue of notice after his death is not saved by 159. If a notice is issued while he is alive, but before the order is passed, he is dead, that could be validly continued as against the legal representative. Notice issued on a person before he died, but after the issue of notice he dies before passing the assessment order. It is a case of a proceeding validly initiated before the person died that could be continued in the name of the legal representative without having to issue any more notice.
Fine, sir. Thank you, sir. Yeah.
Yes.
Yeah. Any other question, Dilip bhai?
Sir, there is a request from one of the members that, sir, can you explain a little briefly this doctrine of merger?
So doctrine of merger is like the order of the lower court. Once it is considered by the order of higher court, the order of the lower court ceases to exist. It merges with the order of the higher court. So you have the concept of full merger and the partial merger. If you look at, for example, 147, third proviso, or section 263, or 154, these will consider the cases of partial mergers. That is why you will see under 263, the commissioner wouldn't have the right to revise if a matter has been the subject matter of an appeal. So to that extent, there is a merger. So this is the concept of merger. These are all the cases of partial mergers. When nothing is stated, it is always the case of complete merger. So normally the order of AO merges completely with CIT appeals. The order of CIT appeals completely merges with the order of tribunal. But then wherever the Parliament considers that the full merger will be prejudicial to interest of revenue, explicitly they would have provided for only partial mergers. So this is the concept of the merger, the doctrine of merger, and the legislative intervention to say that no, this is not a complete merger, this is only a partial merger, and to the extent it is merged, you don't have right to revise or right to rectify or right to reopen. To the extent it is merged, you have not merged, you have a right to revise, you have a right to rectify, you have a right to reopen. Yes, sir.
Fine, sir. Next question is there, sir. This question is from Mr. Dharan Gandhi, sir. He asks, sir, how do we reconcile the judgment in the case of Maruti and Skylight? Skylight says that it was a curable mistake. Here in the case of Maruti, the name of the successor entity was written in the order.
Yes.
Does it not mean that this was a curable mistake?
Yeah, here is a case where despite the intimation to the Department of the Scheme of Amalgamation, in Maruti, assessing officer went on to issue the very notice of 143(2). That is the trigger. That is the trigger. Still in the name of the predecessor. Whereas in the case of Skylight Hospitality, you had a tax evasion petition. You had the reasons to believe under 148. You had the approval under 151. All having been properly made in the name of the successor. It is just that when the assessing officer writes the notice, he inadvertently writes the notice in the name of predecessor. On the basis of, that's why you have to very carefully look at the decision of Delhi High Court and the SLP order of Supreme Court, where they've said the peculiar factual matrix. So that means it is not the normal position. It's in that peculiar case, you will have Skylight. In the rest of the cases, you will have Maruti and the spice infotainment. The majority of our cases will get covered by Maruti and spice infotainment. It's only in this peculiarity of the case you will get covered by Skylight Hospitality, number one. Number two, as I said earlier, in the case of spice infotainment and in the case of Maruti Suzuki, it is the case of civil appeal. In the case of spice infotainment, it is only a case of dismissal of SLP. So it has its much inferior value as compared to dismissal of civil appeal. So this is how we'll have to distinguish the case of Maruti Suzuki and spice on one side and spice the Skylight Hospitality on the other side.
Fine, thank you. Sanjay, you have any questions?
No, sir.
I think we will move, sir. We will move because
After
we have
all
a very
are-
interesting
all have been
case now.
covered.
Okay, fine, sir. Fine, sir.
Yeah,
Go ahead.
because now this itself will take good amount of time. NDTV case.
Please, sir. Yeah.
You know, a lot of interesting things about GAR and round tripping and those aspects. So, only thing is you have to hear the facts very, very carefully here. NDTV, you know, is a very popular TV channel. And between 2006-7 till 2009-10, it set up a fleet of overseas subsidiaries, about 33 of them. 4 in Netherlands, 4 in United Kingdom, 3 in Mauritius. Several such subsidiary companies were incorporated. And over a period of 3 years, assessment year 7-8, assessment year 8-9, and assessment year 9-10. The subsidiaries of NDTV in UK and Netherlands raised huge capital. Please understand, the capital was raised by the subsidiaries, overseas subsidiaries, not by NDTV, who is a tax resident in India, by its subsidiaries. In fact, $20 million in assessment year 7-8, $100 million worth about 400 crores in assessment year 8-9, and about $150 million worth about 642 crores in assessment year 9-10. We are concerned with assessment year 8-9. In assessment year 8-9, as I've said earlier, its subsidiary in UK, you may call it as NNPLC. It raised capital worth about $100 million by way of step-up convertible coupon bonds. Step-up convertible coupon bonds, which are redeemable after 5 years with a premium. Please understand, these step-up coupon bonds are convertible into equity, and otherwise, if not converted, they're redeemable after 5 years with a premium. And it raised about $100 million. Now, and interestingly, after 2 weeks, there was a premature redemption of these bonds. Actually, the bonds were to be redeemed after 5 years with a premium. Instead of redeeming it after 5 years with a premium, these bonds were redeemed sooner, prematurely, not with a premium, but with a discount. And the investor was paid only 74 millions, which will mean that 26 million is the hard profit made by NDTV subsidiary. In other words, it issued bonds worth 100 billion and it discounted it at 72 million and it was left with a balance of 28 million. Now, this is essentially the story. While doing the assessment for 2008-2009, assessing officer did a transfer pricing exercise. He looked at NNPLC, that is the UK subsidiary, and said that the UK subsidiary hardly had any capital base. It hardly had carried out any meaningful business. Who would have given $100 billion without your assurance? And it looked at all the meetings and it found that NDTV India had agreed to give a bank guarantee, a corporate guarantee, not bank guarantee, corporate guarantee to these investors to guarantee their investment of $100 billion. But it turned out that NDTV did not in fact give the guarantee, although it had agreed to give the guarantee, it did not give the guarantee. But had agreed to give the guarantee. You may not have actually given the guarantee, but it is like an implicit guarantee. The investor who gave away 100 million had your even verbal assurance at least. And therefore, it is a case of an international transaction where you had given a corporate guarantee, where you ought to have received a guarantee commission. And assessing officer said that you ought to have received an arm's length guarantee commission in respect of so-called implicit guarantee on $100 billion, and he made an addition of 18.72 crores. At the rate of 4.68%, he made an addition of 18.72 crores. 4.68% is the interest factor that was applied on $100 million for the broken period, and hence you got about 18 crores. Now, NDTV challenged this before the tribunal. So, the matter is now pending in Delhi tribunal on this issue. Whatever I have explained to you is the quantum assessment during the original assessment proceedings. So, during the original assessment proceedings, $100 million bond issue by UK subsidiary. Department says NDTV India gave an implicit guarantee. It ought to have received an arm's length guarantee commission, which worked out at 4.68, came to about 18 crores, and the addition was by inter alia various other additions. So, matter is now pending in appeal before the Income Tax Appellate Tribunal. Now, in the meanwhile, interestingly, 148 notice was issued on 31/3/2015. Kindly note the date here. This is the last date. If you look at the assessment year 8-9, 6 years from the end of the relevant assessment year, in terms of section 149 subsection 1, would have lapsed on 31st March of 2015. So, notice is issued on the last day. What are the reasons given in the notice? The reasons given are, in the assessment year 9-10, interestingly next year, the DRP held that $150 million raised by UK and Netherlands subsidiaries of NDTV are in fact a sham transaction. It is essentially that these companies are only the post box companies. They could not have raised $150 million worth about 642 crores. And therefore, it essentially a case of unexplained investment, unexplained money of NDTV or unexplained cash credit of NDTV per se. It is not the income or the capital raised by the subsidiary. It is essentially the income of NDTV. And therefore, the notice was issued and the reasons were submitted. Now, assessee, as usual, objected to this because the huge demand of tax on 642 crores and also about rather 100 crores because it's a case of reassessment, as I've said earlier. In 910, the DRP said that 150 million is a sham transaction. On the basis of DRP finding in respect of 150 million for assessment year 910, for assessment year 8-9, the department now seeks to reopen. Assessee raises objections. When assessee raises objections, interestingly, in the order overruling objection in compliance with the order Supreme Court in GK and Drive Shots case 259 ITR 19, the assessing officer invokes the second proviso to section 147. What is second proviso? Second proviso to 147 says the benefit of first proviso, which gives a limitation of 4 years in the case of full and true disclosure, would not apply in relation to an income relating to an asset which is located outside India, including a financial asset, which has escaped assessment. So if an income has arisen or if an income relates to a foreign asset, the protect the first would not able is what is sought to be stated by the second proviso. Now, interestingly, you may notice here, the second proviso was raised for the first time by the department in the order overruling objection. It was not given in the notice. It was not given in the reasons. It's only after the reasons were objected to by the assessee. In the order overruling objection, department invokes the second proviso. Now the matter goes to Delhi High Court on a writ petition. Delhi High Court dismisses the writ of NDTB on the basis that you failed the protection of first proviso itself. There is a failure to give full and true disclosure. Therefore, you will not get the benefit of years. You will come up to 6 years. Therefore, a notice issued on 31st March of 2015, though beyond 4 years, is well within 6 years, and because there's a failure on your part to make full and true disclosure, the issue of notice is within the limitation. And inter alia, Delhi High Court also held that there is reason to believe, and there is a failure to make full and true disclosure, and hence the reassessment proceeding is validly initiated. Now, the assessee files a SLP. When the matter goes to Supreme Court, 3 questions were raised. In fact, Supreme Court took up 3 contentions. Although several arguments were raised, here I had the advantage of having a chat with Mr. Arvind Datar, who argued this case in Supreme Court. So the information I have is that several other contentions were raised, which I will anyway highlight a little later. But what Supreme Court considered for its disposal are only these 3 contentions. Is there a reason to believe? Point number 1. Second contention, did the assessee make a full and true disclosure? Third contention, could the revenue have invoked the second proviso? See, invoking second proviso, as I've said earlier, will mean 2 things. You will not get the benefit of lower limitation of 4 years under the first proviso. 2, you will have the extended limitation of 16 years under 149(1)(c). This is extremely important. You will have an extended limitation of 16 years if it is a case of an income in relation to a foreign asset. Now, could the department have invoked the second proviso? So these 3 contentions were raised. Now, in the Supreme Court, the first thing the assessee argued is, look, during the original assessment, hear me carefully, during the original assessment, the department was aware of this $100 million. It asked for information. I gave the information. It did not choose to call $100 million as my income. Rather, it only stated that the subsidiary raised the capital using your name, your implicit guarantee, meaning I had to only pay 18 crores as arm's length guarantee commission. If I have to get the commission of 18 crores, which means department has accepted 100 crores as capital validly raised, meaning department has taken a view. Department has taken a call and agreed that the very fact that they have called this 18 crores as my commission, which could happen only if the 100 crores is accepted, If the 100 crores is not accepted, if it were to be treated as my income, where is the question of me having to pay 18 crores guarantee commission? This argument of the SSC, unfortunately, was met with dismissal without a reasoned order. Before even getting into what the SSC was wanting to argue, at the threshold itself, Supreme Court says, we are not agreeable to this proposition. That there is a change of opinion. SSC wanted to argue that a view was taken. It is a case of change of opinion. Supreme Court at the threshold said, we are not agreeable to this. And without any discussion of any precedent case law. No, this is one part. Now, coming to the reason to believe. Next point which SSC argued is there was no reason to believe. There is no tangible evidence. What the Supreme Court here did is, it went into the complaint by the minority shareholder, which was taken cognizance of by the DRP for the subsequent assessment year 2009-10. And the final order passed by the assessing officer in pursuance to directions of the DRP. And what Supreme Court said is it referred to SSK's case, another prior Supreme Court decision, in 247 ITR 818. The Supreme Court said that a finding which you will have in a subsequent assessment year could be an information which could prompt you to go for reassessment of the past year. And therefore, what the Supreme Court said is the material disclosed in the subsequent assessment year could be an information which is available for the purpose of having a reason to believe that the income of the prior year has escaped assessment. And therefore, the Supreme Court said that the department had a valid reason to believe. So please note here, the first contention of change of opinion is dismissed. Second contention of the SSC that you don't have a reason to believe is dismissed. Now, when it comes to second proviso, now here is a question of second proviso. Second proviso was invoked by the department only in the order overruling objection. Supreme Court said it is impermissible for department to have raised this contention through an order overruling objection. It ought to have done it originally. It ought to have done it originally, if not at the notice stage, at least at the stage of recording of reasons. An SSC cannot be surprised. In fact, Delhi High Court relied on Mohinder Singh Gill's case, and there is a decision of Bombay High Court in Hindustan Liver's case. There are several decisions which have said that the reasons cannot be allowed to grow with ingenuity. It is not like an old wine which gets tastier with the passage of time. You cannot improvise the reasons. Now the Supreme Court has given a stamp of approval on the improvisation of reasons. It said, no, you cannot improve the reasons. You cannot add a new dimension to it in your order overruling objection. And therefore, it said you could not have invoked second proviso at this stage. Now, how did this win this case? SSC won this case not on change of opinion. SSC won this case not on reason to believe, but SSC won this case on the basis of first proviso. Now, when the second proviso is ruled out by the Supreme Court, SSC will have to fall back on first proviso. Here is where Supreme Court agreed with the SSC that there is a full and true disclosure. Now, because there is a full and true disclosure, because Supreme Court said SSC gave all the primary facts. If any additional information was required, if the secondary facts were required, it is up to the assessing officer to have asked for the same. Under explanation 1, it is enough if the primary facts are disclosed. So on this basis, Supreme Court said that the benefit of first proviso will inure to the SSC. Second proviso will take away the benefit of first proviso is not applicable because it was not stated in the reasons to believe. SSC is protected by the first proviso. Notice ought to have been issued before 31st March of 2013, whereas here is a case where the notice was issued after 31st March of 2013. It was issued on 31st March of 2015, and therefore notice is to be quashed. An important point for consideration. Now, so although NDTV would have won the case here, there are a lot of interesting aspects which will emerge from this decision. And you would notice that several points, several contentions, though raised have not been taken, though not authorized, ought to have been taken. What are these contentions? One is the change of opinion, review versus reassessment. Two, did any income ever arise? Here is a case of issue of capital by a subsidiary based out in an overseas jurisdiction. Did any income ever arise from issue of capital? Even if the income were to so arise, whom did it arise to? Three, subsidiary structure. It's a subsidiary incorporated under the laws of United Kingdom and Netherlands. And could the subsidiary structure have been ignored in the absence of guard provisions? Please understand, chapter 10A, sections 95 to 102 were not applicable during this period of time. They were covered by the decision of Vodafone in 341 ITR 1, where the corporate structure couldn't have been just like that ignored. Thirdly, another point is the scheme of third proviso. The third proviso says, if there is an income that involves matters which are subject matter of any appeal, reference, or revision, it is not the income which has to be subject matter. Income involving matters which are subject matter of any appeal, reference, or revision. And it is impermissible for the assessing officer to invoke the reassessment because it's barred by the third proviso. Now, as you know, on the issue of guarantee commission, this matter is now before the Honorable Delhi Tribunal. This being before the Honorable Delhi Tribunal, to my knowledge, is still before the Honorable Delhi Tribunal, insofar as assessment year 8-9 is concerned in the quantum proceeding. If it were so, could it not be argued that it is a matter which is subject matter of an appeal and the income relates to that? And therefore, the assessing officer could not have invoked third proviso. Now, these are the points which, were not at all looked into by the Honorable Supreme Court, although some of these points, to my knowledge, have been raised in the course of argument. Now, let's look at each one of them. Now, here is a case where assessee argued. How much time do you have? It will take some time. You would want me to continue discussing it?
Yes, sir. Yes, sir.
Please
Yeah, you continue, sir.
We'll go up to
115.
We'll go up to 115.
Yeah, but continue. This is interesting and important too.
Yes. Now, the assessee wanted to argue here that the assessing officer had already examined this case and he accordingly applied arm's length guarantee commission and taxed me on 18 crores, which means he has impliedly accepted $100 million issue, and therefore it's a case of change of opinion. Now, here is extremely important for Supreme Court to have considered the Kelvinators case in 320 ATR 561, paragraph 13. Supreme Court very clearly says, paragraph 4 and 5 rather, where the Supreme Court very clearly says change of opinion is a built-in safeguard. You don't find the word change of opinion in 147, but it is a built-in safeguard to avoid the abuse of this process. And it went into the proposed amendment in 87, and after a protest by the taxpayers, the proposed amendment of the opinion is dropped, and therefore Supreme Court said that the power under 147 is to reassess and not to review. So there is a difference between reassessment and review. Now here is a case where assessing officer had already called it as the proper issue by charging corporate guarantee commission, and therefore it is a case of a change of opinion. So merely because in the subsequent year 9-10, in respect of $100 million, DRP takes a view that it is sham. That would not in any manner mean that the earlier opinion made is incorrect. Earlier opinion made remains an opinion. And in fact, very interestingly, a point which needs to be noted is, in assessment year 9-10, as the department called 150 million as sham, please hear me carefully, in 9-10 department called 150 million issue as sham. In 9-10, it continued to make ALP adjustment of so-called corporate guarantee in respect of the $100 million issue which was made in 89. So the very fact that the assessment proceedings for subsequent year continued to make ALP arms TP addition in respect of very same $100 million. Mr. Sharma, can you just remove your hand?
Yes, sir.
Yes, yes, yes.
Yeah.
It was blocking your face.
Yeah, sorry.
So I was thinking you are watching the time and I was wanting to stop.
No, not at all, sir. I told you.
Sir, we have started late also, sir. So it is, we don't mind, sir.
No,
if you
it's
can
only
continue.
it's only in the lighter vein. It's only in the
Okay,
lighter
okay, sir. You can carry up to 1:30, sir, if you are comfortable, sir.
No, we'll see. We'll just try to complete
Okay,
as much as we can.
That's nice
Yes,
of
sir.
you, sir. Nice of you.
No. So interestingly, as I was trying to say, while the department made $150 million addition for 910, it continued to make the arm's length guarantee commission adjustment in 910 for the $100 million issue of 89. That means even in their proceedings in the assessment year 910, department continued to accept the $100 million issue. That being so, it is not discernible as to how the finding of the DRP on $150 million in 910 could be an information in possession of the department as regards falsity of my information for 89. So this point was not considered, unfortunately. In fact, what the Supreme Court said is, what you require is only a prima facie view. You don't require a comprehensive and a consolidated and a proper and a detailed view. And if you have the information in the subsequent year, that is good enough for a valid reason to believe. But here is a case where the Supreme Court made a mistake, according to me, with due respect to Supreme Court. It relied on Poolchand Bajranlal's case of 203 ATR 6. So Poolchand's case, it was a case of whether there was a failure to make full and true disclosure. You would recall that in NDTV case, Supreme Court said there is no failure to make full and true disclosure. There is absolutely no failure to make full and true disclosure. That means, according to Supreme Court, assessee had made complete disclosure. When the assessee had made complete disclosure, and department had not doubted $100 million, not only in the proceeding in 89, but also in the proceeding in 910, because it continued to make the corporate guarantee adjustment. How this could ever be an information in possession of department to disbelieve the statement made by the assessee during assessment year 89. So this is the point which, according to me, with due respect, the Honorable Supreme Court has missed. Particularly having held that the assessee did not fail to make full and true disclosure. Supreme Court gave the benefit of first proviso, which means assessee made the full and true disclosure. Then on what basis could anyone have said that there is no change of opinion? In fact, that opinion continued even in their assessment year 2009-10 proceedings. And Supreme Court interestingly did not refer to the decision in Taxpan's case. In 404 ITR 10, Supreme Court said the reason to believe is a phrase which cannot be liberally interpreted. It requires a very strict interpretation. Supreme Court says if the assessment is non-speaking, cryptic, in para 12, but it hastens to add in para 13. But if the issue was considered during the assessment proceedings, then the reopening is vitiated by change of opinion. So what the Honorable Supreme Court in NDTV's case held about reason to believe is not in consonance with the prior decisions of the Supreme Court in Kelvinator's case, as well as in Taxpan's case. And therefore, in another case before the Supreme Court, one has to argue that the decision here, insofar as it relates to reason to believe, insofar as it relates to change of opinion, per incurium, because the precedent case law has not been appropriately considered here. Now, on interpretation of explanation 1, it says merely placing before the assessing officer the books of account and other documents would not amount to full and true disclosure if the assessing officer due diligence could have unearth the primary facts. So this is something which has been there in the statute book. And this is what was explained by the Supreme Court in Calcutta Discounts case, Constitution Bench in 41 ITR 191. And Supreme Court reiterates this here to say that your obligation is only to disclose the primary facts. The further factual inferences, further legal inferences, you need not assist the assessing officer in respect thereof. Now, another interesting aspect of this is the which the Supreme Court held in favor of the assessee. So what Supreme Court held is, if you have to use the second provision, you should have used it in the reasons to believe and not thereafter. And one another thing is, when department argued in Delhi High Court, it did not argue on second proviso. It argued on first proviso, on full and true disclosure. When it came to Supreme Court, and once the Supreme Court said there is a full and true disclosure, department started arguing the second proviso. Now, interestingly, what Supreme Court told the assessed department is, you cannot argue one thing in the High Court and argue another thing in the Supreme Court. In the High Court, you argued on full and true disclosure. In the Supreme Court, you are arguing on second proviso. So which will amount, according to Supreme Court, blowing hot and cold at the same time. So Supreme Court here reiterated what it had earlier held in Woodward Governor's case, 312 ITR 254, in the context of forex gain and forex loss. So Supreme Court had held that revenue cannot seek to tax the forex gain in the year of gain, but ignore the loss in the year of loss. It will amount to blowing hot and cold at the same time. So one another takeaway of the Supreme Court decision in NDTV is bar on revenue to blow hot and cold and take contradictory stand. Next is improvisation of reasons. So as discussed, they sought to improvise its reasons through the order of overruling objection, which the Supreme Court said you could not have done it. Now, the negative part of this decision is, what Supreme Court said is, having quashed the reassessment, it said, of course, you can still, if you want to, invoke the second proviso by issuing a fresh notice if you want. Now, 16 years time is still available to revenue. Earlier proceeding is bad because second proviso of income in relation to a foreign asset was not raised in the notice and the reasons. But now 16 years time period is still available to revenue. It still has time. In terms of section 149 1C, read with second proviso to section 147, it still has the time. Now the issue for consideration is this a direction by the Supreme Court? Is it a finding by the Supreme Court that the revenue is free to issue a notice afresh? Or is it just an obiter? Now, what is the direction? What is the finding? What is an obiter? You may go to the decision of Supreme Court in Rajendranath's case, 128 TR 14, where a finding or a direction is understood to mean a finding or a direction which is required for disposal of the case. Now, the observation by the Supreme Court that the revenue is free to issue a notice is not a finding or direction which are necessary for disposal of the case. It was only at the most session. It is an obiter. It is not a direction or a finding. Therefore, the benefit of section 150 subsection 1 is not available. However, department will still have time of 16 years in terms of 149 1C. Now, that the department has time of 16 years now, with reference to assessment year 910, they still have time now. And I get to know that department has already issued a notice. It has issued one another notice under 148 to NDTV. So we will now not know how the NDTV would react to it and how the revenue would dispose the order overruling objection. But thing is, we will still have this benefit of change of opinion. See, change of opinion is a defense available all across section 147. Whether you invoke 147 first proviso, whether you invoke 147 second proviso, whatever provision you invoke. As of the department has already held that assessing is not failed to make full and true disclosure. Point number one. Point number two, as I've explained earlier, this was a matter which was already decided by the assessing officer, and it took the very same stand in the subsequent year also. Even in the proceeding before DRP for 2009-10, as I've repeatedly been saying, department continued to make the arm's length guarantee commission adjustment in the transfer pricing, continuing to accept this $100 million. So therefore, according to me, NDTV would have. Now the question is, interestingly, this will take you to the developments in the next year in the context of NDTV 2009-10. As I said earlier, in the assessment proceedings for 9-10, what the department did is the 150 million issue made by the Netherlands subsidiary as unexplained cash of NDTV, unexplained cash of NDTV, or alternatively unexplained money of NDTV. So either section 68 or 69A and B. So both were invoked. Now, interestingly, if you see the facts of 9-10, you would also, get to know a lot about round tripping and other things here. For a while, I'm not suggesting that NDTV in fact asserted round tripping. I'm only explaining the facts. See, NDTV issued 150 million worth of dollar worth of issue. In rupees, it comes to 642 crores at the rate of 7,015 rupees per share, as against a very paltry face value of the share. That is in year one. In the very next year, what was issued at 7,015 rupees per share was bought back at 634 rupees per share. Please hear me carefully. 642 crore was collected, and it was bought back by paying only 58 crore, which meant a good amount of 570 plus crore was lying with NDTV. 1 year I issue shares worth of 642 crores. Very next year I'll buy it back at 58 crores. So huge amount is now left with me. Now, the question for consideration is, could it be called as section 68 or 69A or B? Now, here is a case, interestingly, what happened was a minority shareholder lodged a complaint. What he complained was, this entire 642 crore, which was received by the subsidiary, eventually found its place with NDTV through several mergers and amalgamations, which I'll explain a little later. And this is how it was explained in the complaint by a minority shareholder that NDTV is into money laundering and it is into round tripping. And it was alleged that NDTV's own money came back to NDTV through this kind of a web of companies. This was the allegation in the complaint. And I guess, the courts were considering all these allegations, all these facts. And eventually, they also noticed that the company which issued the shares worth 642 crores, which bought back, was wound up on 28th of March of 2011. This matter, when DRP confirmed the assessing officer passed the final order, it went to the Honorable Tribunal, Delhi, and the Honorable Tribunal, Delhi upheld the addition of 642 crores on the premise that there is a case of a round tripping, and the department rightly invoked 68 and 69A and B. Now, if you look at section 68, 68 is some sort of a rule of evidence. You have Mohan Kala's case in 291 ITR 272, where the Supreme Court said that it is essential that the money has to be found credited in the books of NDTV. Now, here is a case where this money is not found credited in the books of NDTV. In the relevant year, I am for a while going to 9-10 because it is a far-reaching consequence. It's quite important for us to understand. We also need to know the facts of 9-10. Because ultimately, it will come back to 8-9 because the department, as I said, has already issued a notice in respect of 8-9, invoking second proviso. So whatever we discuss here will also apply to 8-9. Now, can this money which is found credited in the books of subsidiary be found to be credited in the books of NDTV. Is it permissible to lift the corporate veil when you don't have the benefit of sections like GAR sections? You have section 98, you have section 98.2, you have section 98.3, you have section 98.1 itself, which will permit the revenue to pierce through your corporate structure, see through the corporate structure. See, Supreme Court in Vodafone case in 341 ITR 1 said you have to only look at, you cannot look through. So that was undone by introduction of GAR. But the GAR provisions are not applicable to the year in question. One another interesting part here is, even here before the Honorable Supreme Court, issue of guarantee commission arose. But when it was dealing with issue of guarantee commission, whether issue of corporate guarantees in international transaction or not is to be determined, and a special bench case is already pending, and therefore the Honorable Delhi Tribunal said that this issue will have to wait till the special bench decides. Now, interestingly, you may wonder for a while here that if the guarantee issue still survives, which will mean the issue of capital will have to be accepted. If you collapse the NDTV subsidiaries and NDTV together and treat them as one and the same, where is the question of international transaction? There cannot be international transaction within the same self person. So this is another interesting point which will have to be taken into note as to if guaranteed transaction were to be treated as a transaction and an international transaction between two entities, then on what basis will you lift the corporate veil and treat the money that is credited in the books of NDTV subsidiary as the sum which is found credited in the books of NDTV India? So it's an interesting point for consideration, which we'll have to examine here. Now look at the structure, which you'll find in the order of the Honorable Tribunal, which is a very detailed order, which will run into almost 400 pages. So here is a case where you have Universal Studios Netherlands. You will see at the bottom there, has subscribed to about 31.4% stake in NNIH of Netherlands by paying 642 crores. And as soon as NNIH got this 642 crores, it gave dividend to its holding company, NNBV. Now, interestingly, entire dividend was paid to NNBV, which held only 68% share, and no dividend was given to Universal Studio, which also held 31% stake. Please look at the way the money has flown here. Universal Studio gave away 642 crores, acquired 31% stake, and this Netherlands company gave away the entire amount as dividend to just one of its shareholders, that is NNBV, which now holds only 68%. It did not give 1 rupee dividend to Universal Studios of Netherlands, though it held shares up to 31%. And what did NNBV did? NNBV, once it received this amount of dividend, what it did is, look at the routing of money here. Very, very troubling. So NDTV has a, has to do a lot of explaining as to how this is done. What NNBV, which took this money, did is, it gave away 389 crores to NDTV Mauritius. NDTV Mauritius in turn invested same amount in NDTV Studio. And NDTV Studio merged with NDTV. So you find that whole of 389 crores is now sitting with NDTV India. And about 250 plus crores, NNBV gave loan to NNPLC, which merged with NDTV1, which later on merged with NDTV India. Now you would see the whole of 642 crores, which was given by Universal Studios to NNIH, went to NNBV, and then it eventually moved to NDTV. So it's a classic case study for us. If GAR were to apply now, if similar thing were to happen now, how department could have viewed and how department could have applied the provisions of 144BA. See, GAR will have to be invoked by the assessing officer, by issue of notice under 144BA. He has to give a show cause notice under Rule 10U. Then the matter has to go to the principal commissioner. Then from there, the principal commissioner has to take it to the approving panel. All these are there now. So it's a very interesting case study for us to apply GAR in the present situation, apply the factual matrix, bring it to the present situation, and see how this could be regarded. Could it be regarded as a classic case of round tripping without a substantial commercial purpose? Then will it become an impermissible avoidance arrangement under section 96? And will it also mean obtainance of good amount of tax benefit, much beyond the threshold of 3 crores? And if GAR is invoked, what are the natural consequences and the determination of tax consequences under section 98? So these are the aspects which will have to be taken up in this case study. So that's the end of our discussion on NDTV. And we have gone up to 1:15. Sharma ji, shall we close now?
Yeah. Yeah. No, sir. One more case at least we can take. I leave it to you which case.
Yeah, so
yeah, please.
Do we take up this black money case or Ivan case? So there are 3 more cases I have here. One is the case of Supreme Court in Ivan Interactive case.
Yeah.
Maybe we can take this case. It's a short case.
Yes, sir.
See, facts of this case are that 143(2) notice was issued to an address, which the company claimed is no more my address. Subsequently, a proper notice under 143(2) was issued, but by then the time limit for issue of notice had lapsed. So it was beyond the time limit. So all the lower appellate authorities like the Commission of Appeals, the Tribunal and the High Court held that the issue of notice to the wrong address is bad. Therefore, the jurisdiction to assume the scrutiny proceeding is bad in terms of Hotel Blue Moon's case, 321 ITR 362. Subsequent notice is beyond the limitation of time, and therefore the assessment order was quashed. When the matter went to Supreme Court, Revenue argued a few points. Firstly, Revenue argued that we have issued 143(2) notice on the basis of PAN database. There's a PAN database. This address was available. We picked it and issued the notice. Revenue also argued that the assessee did not intimate us change of address. There was a communication dated 6/12/2005. There was a alleged communication dated 6/12/2005, which says that the assessee has intimated the department. However, department argued in the Supreme Court, show me that intimation. Assessee gave an affidavit saying, I don't have the copy of the intimation. But the lower authorities like CIT Appeals, Tribunal, and the High Court relied upon this alleged communication. And unfortunately, when the matter reached the Supreme Court, the copy of the communication was not available. Supreme Court asked the assessee, are you able to give it to me now? Assessee said no. So on this basis, what Supreme Court said is, the assessee argued this. Assessee interestingly put 2 arguments. One is I have filed Form 18 under the Companies Act, intimating the change of address. Secondly, assessee made an interesting argument which was not considered by the Supreme Court, that for the assessment orders of the earlier years, see here, this is assessment year 6/7. Assessment orders for the earlier years 4, 5, and 5, 6. Department had issued the assessment orders to the new address, which means department was in the knowledge of the new address. Department knew the new address. Otherwise, how could the department have issued the assessment orders for 4, 5, and 5, 6 to the new address? Then Supreme Court held, no, we are not accepting it because firstly, you are not able to show the alleged communication dated 6/12/2005. Your filing the Form 18 would not suffice. You have not made an application to the department intimating the change in address. It is your duty to have filed Form 18 and filed a copy of the Form 18 filed with the company's authorities, with the income tax authorities, and you ought to have got your PAN database changed. Because you have not done it, department is justified in issuing notice on the basis of PAN database. Now, what Supreme Court said is, your selection and the selection of return for scrutiny under 143(2) is PAN based. Because it is PAN based, the issue of notice is absolutely fine. So this is what the Supreme Court said. Now look at this interestingly. Look at the provisions now. If you look at 139A, subsection 5, clause B, wherever there is a change in address, you have to intimate. But 139A 5D would not say how the change in address is to be intimated. There is no format. You can write a letter. You can even file your return also with a new address. And interestingly, you have to understand that this assessment here related to period prior to amendment to section 282 and introduction of new rule 127 in pursuance to 282 subsection 2. All this related to the earlier period. During this period, we did not have a very clear department procedure available as to what is the basis for picking the address. My view is that when your return is picked for scrutiny on the basis of various risk parameters, while you look into all those, why don't you look into the very same return for the address mentioned? So therefore, to say that the address mentioned in the return is not the criteria, but the address mentioned only in the PAN database is the criteria, may not be appropriate. Although the scrutiny decision would be taken on the basis of the return, it would be incongruous to argue that the address mentioned in the return will have to be ignored. For the address purpose, you have to go back to PAN database. May not be very appropriate. In fact, the Honorable Supreme Court did not discuss several decisions. One is the Mascomtel, Delhi High Court, Punjab and Haryana and Sunil Kumar Chabra's case. Another unreported decision of Delhi High Court in Ashok Kumar Jain's case. All these have said that the address will have to be picked from the return file. In fact, if you look at the Manual of Office Procedure, Volume 2, issued in 2003, there is nothing which clearly stated that you have to pick the address only from the PAN database. It talked about Assessee Information System, AIS, and it also had PAN database. It had Assessee Information System. If you look at paragraph 6.3, it appears to suggest, I am not saying it categorically says, it appears to suggest that whenever in the return you give away new address, that new address will have to be captured in your PAN database automatically. Now here is a case where the assessee indicated its new address in the return. So the department system should have captured that new address and updated the PAN database. But unfortunately, all these aspects appear not to have been canvassed properly before the Honorable Supreme Court, or if properly canvassed, may not have been properly appreciated with due respect by the Honorable Supreme Court. And therefore, interestingly, we have a decision which is adverse. But you do not have to worry. The decision in this case will not apply to us anymore, because this applied during the time when 282 and 127 were unamended. Now you have 282(2) and Rule 127. Sub-Rule 2 will give you how the addresses will have to be gathered. Now there are 4 sources to gather the address under 127(2). One is your PAN database, or the address mentioned in the latest return, or address mentioned in the relevant return, or the address mentioned in the corporate website, the company law website. One of these addresses could have been picked. So this is how, like the decision of Supreme Court will have to be understood in the context of change of law under section 282, read with a new rule 127 sub-rule 2. I think with this we will close. There are about 3 more decisions which we can discuss maybe on some other occasion, but definitely not the 3rd session. I guess the learned audience would have been bucked to seeing the same face over and over again. So I would thank the chambers for giving this wonderful opportunity. And thank you, one and all.
Okay, any question, Dilip bhai?
Any questions? Yeah. You can ask me any questions. Sorry.
Sir, now in the case of this, hello?
Yeah, Dilip, can I?
Yeah.
I have
yeah, you proceed. Yeah.
Chaitanya sir.
Yes, sir.
You mentioned about Rule 127. Now, as you have mentioned, there are 4 occasions wherein the addresses can be picked up from. So,
Yes.
on the contrary, this decision would support that now either of these four, wherever these addresses are there, the department can pick up the addresses from any of these four.
Yes. If you look at 127.2, there is no priority.
Yeah.
There is no priority between these four, addresses. So it is open to the revenue to pick up any one or more of these addresses. Only exception is, there's an exception. If the assessee has specifically asked the revenue, irrespective of these four factors, you have to give the notice only to this address. Then department is bound to issue notice to that address.
To that address. Right. Yes, sir. All right. Dilip bhai, any other questions? If you have, you can take up. I think Sharma ji.
Yeah. No other question.
Dilip bhai.
Sir, just 1 minute. Yeah. Sir, what about the Black Money Act for this NDTV? Sir, whether the Black Money Act can be invoked, sir?
See, interestingly, there is a mutual exclusion between the Black Money Act and the Income Tax Act. If you would look at the provisions of Section 4 of the Black Money Act, it would say that what is already assessed under Black Money Act cannot be assessed in the Income Tax Act. Now, interestingly, you have a case of income tax proceedings already initiated under the Income Tax Act. Now, for you to invoke Black Money Act, two things are necessary. One is they are seeking to tax this $100 million or $150 million. Is it undisclosed foreign asset? See, there's no concept of undisclosed income in terms of Section 68 or 69 there in the Black Money Act. It is a case of an undisclosed foreign asset. There are a few things here. You don't have provisions of Chapter 5, which will Chapter 6, which will deal with the Section 68, 69, etc. under Black Money Act. You will have only undisclosed income and undisclosed foreign asset. Now, in order that it is undisclosed foreign asset, firstly, it should belong to you. Point number one. Two, you are unable to explain the source. So here is a case where, question is, could you have argued that it is not your money? It is not your asset. You don't have any domain over that asset. Two, even if it were to be treated as your asset, are you not able to explain the source by arguing that it is Universal Studios that gave away money to NNPLC, NNPLC gave it to NNBV, NNBV gave it to XYZ companies, and XYZ companies eventually gave it to me. And ultimately, the money has come to me and money is lying in India, so far as NDTV is concerned. It has reached the coffers of NDTV. So it may not any longer be an undisclosed foreign asset. It is located very much in India. It's an interesting development, of course. But department is barred from invoking both the income tax provisions of 147 as well as black money.
Fine, sir.
Black money they have 10 years time. Yes.
Oh, okay, sir. Fine, sir. Sir, now the other thing is you said that the second proviso also cannot be made applicable in this case. You had given the view that the second proviso also cannot
that is on the basis of that is on the basis of the all pervasive defense of change of opinion. See, change of opinion is not permitted, whether it is within 4 years, within 6 years, or within 16 years. That is a defense available. So even if the department invokes second proviso, once the Supreme Court has held that there is no failure to make full and true disclosure, that means I have made full disclosure. That means department has accepted all my documents. Even in the subsequent year, department continued to make addition in respect of corporate guarantee commission in relation to this $100 million. So how could they change the opinion now? On what basis is the question. So the defense will have to be articulated extremely properly, extremely meticulously in the next proceedings that would ensue thereafter.
So if you see the second proviso, it reads, sir, provided further that nothing contained in the first proviso shall apply. In a case where income, sir.
I'm not saying I am covered by first proviso. I'm only saying that there is a finding in my favor that I have made full and true disclosure. Point number one. There is a finding in my favor on full and true disclosure, number one. Number two, this $100 million was accepted in 8-9. Same was continued to be accepted in 9-10 because the same $100 million continued to remain, on which they made additional transfer pricing adjustment, not on $150 million of that year. They made even on $100 million of last year in 9-10. So what is the view of the department? If this $100 million were a sham transaction, why did the department continue to make in 9-10 the PP addition on $100 million? Which means department continues to accept this $100 million as a genuine transaction. And that it amounts to a change of opinion now to say that it is not genuine, is what I'm trying to say. I'm not taking the defense of first proviso. I'm going by the finding for the purpose of first proviso that there is a full and true disclosure. So there is still a change of opinion. Yes.
Fine, sir. Thank you, sir. Sir, but the department has got the right to issue a second notice again under 148.
Yeah. There can be any number of notices as long as the jurisdictional requirements of 147 are satisfied.
Yeah, that's right. That was a question by one of the participants. Sir.
Yes,
yeah. Yes. Any other questions, Mr. Sanjay?
Sir, just one thing. One person has asked, can you please elaborate on the distinction between primary facts and secondary case? And to add to that, sir, because what happens is in these cases which are reopened in bogus purchases and all, though we had given some information earlier, still they are being opened. What would be the situation there?
I think he has read it out a little too fast.
Sir,
can you please
elaborate on the distinction between primary facts and secondary facts, considering that now in case of bogus purchases as well as penny stocks, though some information was given at the time of assessment or original assessment, they are being now reopened based on facts of some other, that somebody else has told that these are bogus transactions and all. How can we distinguish between that?
Yeah, interestingly, this is what I was trying to say. If there is any finding in the subsequent year, which finding brings about falsity of your claim in the earlier year, please understand carefully. There has to be a finding in a subsequent year. Which finding brings about falsity of your claim in the original year, then going by 247 ITR 818, SSK case, Supreme Court, your finding in the subsequent year could be an information, tangible evidence. It will destroy your defense of full and true disclosure. Now, if you go to 203 ITR 456, 203 ITR 456, Ulchand Bajranglal's case, what Supreme Court says is, if there is a finding in a subsequent year which brings about a new fact not disclosed earlier, or it brings about some information speaking about the falsity of the fact disclosed in the earlier year, then it will amount to, you will not get the protection of the first proviso, full and true disclosure. Most importantly, in the instant case, Supreme Court agrees with NDTV on the full and true disclosure. So there is no question of falsity being established. So the subsequent information found for 910 has not brought about any falsity of information relating to $100 million funding of 8-9, which is evident from the fact that I am reiterating it for the nth time, that the department continued to make ALP addition of guarantee commission even on that $100 million. So an opinion is made, which opinion is continued, and therefore it is a case of change of opinion. Now coming to primary facts and secondary facts, here is a case where the Supreme Court said it is enough for you to give primary facts. And Supreme Court in NDTV's case has said that NDTV has given primary facts. Interestingly, I have to tell you something else here. During the original assessment, assessing officer asked for individual balance sheets and profit and loss accounts of Netherlands subsidiaries. Assessee did not give. You know the reason which the assessee gave? I have taken an exemption from the registrar of companies for not disclosing it. And Supreme Court, interestingly, upholds, saying that because assessee took exemption from registrar of companies for not disclosing it, assessee is justified in not disclosing the individual balance sheet and profit and loss. Now, interesting question is, if some other law will permit you not to disclose, can you take shelter of this insofar as explanation 1 and full and true disclosure in terms of first proviso to 147 is concerned is another question that would arise. Now, coming back to primary facts and secondary facts, what Supreme Court said in Calcutta Discount 41 ITR 191 is, primary facts are the facts which, when invited to the attention of the assessing officer, he could make inferences. He could make factual inferences, and then on the basis of factual inferences could take a legal call. So these are the primary documents. So what are the primary facts in the instant case? It is that there is a Netherlands subsidiary, there is a UK subsidiary. UK subsidiary made an issue of step-up coupon bonds of $100 million. Who are the persons it has issued to? What is the price? What is the document? These are the term sheets. These are the terms of issue. And this is how it is reflected in my books of account. All these are given. So these are the primary facts. Now, to say that the UK company is a dummy company, it is only a post box company, it is only a sham entity, it did not exist, it is to be ignored and it is to be treated as Indian company itself. What more facts did the Indian company give? What more it could have given? It cannot prove the negative. I cannot prove the negative. So assessing officer will have to ask for this. And when the what the assessing officer has to further ask on the basis of the information which I have already given are the secondary facts. So secondary facts are to be asked for by the assessing officer. Primary facts he need not ask. It is the duty of the assessee to furnish the primary facts. But it is not the duty of the assessee to furnish the secondary facts. It is the duty of the assessing officer to ask for it. If he so asks, assessee has to give.
Thank you so much, sir.